In this video, I will walk you through how to find compounding machines. I will comment on some slides. These are not mine. This is from Joseph Carlson. This is one of the biggest investing YouTube channels, so I encourage you to watch his videos. So I'm just going to comment his slides because I love his investing style and I think it could be very useful to you, my subscribers. But first, check his channel out, watch his videos. These are some great content. Fundamental investing, like Warren Buffett. I like the style. Okay, let me get straight to the point. If you don't know me, if you're new to this YouTube channel, thanks for coming by. My name is Christophe Nour. I've been investing in stocks for almost a decade with a performance of 24% per year. And the goal with this YouTube channel is to help you become a better investor. This is exactly what we're going to do with this video. Okay, let's start. Investment philosophy. The overview of how to find compounders that will grow your wealth for the long term. The overview is buying, holding, and maintaining a portfolio of compounding machines with a disciplined and long-term approach. Don't speculate, gamble, or invest out of fear. Don't let your emotions come in your investing process. So this is like Warren Buffett, purely rational investing. Don't have FOMO, don't have hype, don't want to get in the train, don't get the shiny object syndrome. This is purely rational investing. So how do you do it? There are three main focuses. So finding excessively high quality companies in stock selection, maintaining the right temperament, and exercising prudent portfolio management. So you want to find great businesses with a great attitude, a great mindset, and be conservative, be prudent, and oriented to the long term. So for the stock selection, Joseph Carlson highlights several points. You want a business with a monopoly, with pricing power, operating leverage, organic growth, capital light, smart capital allocation. Don't worry, he will define all of this later. And you want about temperament to be disciplined, unemotional, patient, and long-term focused. That's great. I completely agree with him. And regarding portfolio management, he recommends to have smart position sizing, specific buy criteria, specific sell criteria, and you need to do some intrinsic value work, estimates, so that you only buy cheap companies or fairly valued companies. You don't want to buy expensive companies. Okay, let's continue. For the attractive attributes of a compounding investments, a compounding business, you want some aspects, you want some attributes. Some businesses will be monopolies. Maybe I can zoom in a little bit so you see better. Oh, whoa, okay, this one. Maybe that's a bit better. You may want to only invest in monopolies. So large market share in a concentrated industry, entrenched distribution, brand name, install base, subscriber base, and high barriers to entry. There is a portfolio on Dataroma that only invests in monopolies, and this portfolio is doing great. And I guarantee that if you only invest in monopolies, so superior businesses, either legally or illegally, you will have great results. You will have great returns because these are businesses that can still grow their prices and still people will buy. And you can argue that most of the money Warren Buffett has made out of stocks was thanks to monopolies. Either Coca-Cola that have a large market share, you have Apple with a large market share, Geico was very big at the time, American Express was big at the time, he did a small investment in Visa and MasterCard. Not all investments, I agree with you, but a lot of investments that Warren Buffett did were monopolies. I've read a study out of it, and that's how you can make a lot of money. You want also a business with pricing power. There are some businesses that can grow their prices and they can still grow every year their prices, every year, and customers will buy. So demonstrated history of raising prices above the rate of inflation. Take for example Hermes, the Hermes bags, French bags. They can grow 10% their prices of their bags. Oh, this is not bags, that's Louis Vuitton. Oh no, as a French, that's a bit shameful. No, that's Louis Vuitton bags, 10% every year. You raise your price, and that's it. For Hermes, you have other, I mean, they do bags, but that's not their main area. You can have a scarf from Hermes, increase the price of the scarf 15% per year, and still people will buy the scarf. So that's completely crazy, above the rate of inflation. Yes, upside value in product and service for future price increases. Can raise prices with little pushback from customer. Let me ask you this question. If Apple raises the price of an iPhone $100 more, will it deter you from buying it? If you want a new phone for Christmas, for your birthday, you really don't care if the iPhone is $100 more expensive. You will say, oh, it's expensive, but still you will buy it. So no pushback from customers. You want a business for compounding engines. You want a business with operating leverage. That means each incremental dollar of revenue increases margins. You want scale. You want to invest in a business that, as it becomes bigger, it's become more efficient because of better distribution, better teams, better efficiency, nice culture, long runway of large TAM, so total addressable market, to scale into. Yes, you want a business that's continued to grow and grow and grow. You have Costco in this example, you have Amazon in this example, you have Adobe with this example. You most of the time you want a business with fixed costs, and as you grow, the percentage of fixed costs compared to your revenue will decrease. So as you grow, you become more efficient and more profitable, and your margins grow. There are some businesses like this. Also, you want a business with organic growth. That's a safer way to grow, I would say. If you are a public company, it's nice to have organic growth compared to M&A, acquisitions growth. So that can be tricky. The synergies for acquisitions don't often happen. So organic growth is a very safe way of growing, and that's what you want. You want compounding your wealth for the long term. Does not rely on acquisition for growth, grows by price and volume increases. So yeah, either, let me take the example of the Louis Vuitton bags. You want the price of these bags to go up, so price increase, and you want volume increase, so you want to sell more bags, so more volume, more millions of bags. Hermes is a different story because they don't want to increase the volume, but I would say either price or volume, price is the most important for organic growth. And for organic growth, you want build products internally. Yes, you want a business that don't rely on maybe China, Bangladesh, Morocco. You want a business that invests in themselves, that they do their own stuff, they do their own products, they don't rely on tariffs or something like this. So if there is some international tension, they will not be impacted much, I would say. You want a business that is capital light, so low amount of fixed cost and low R&D, research and development, and capex, capital expenditures related to revenue. That's pure metrics to check. That's how you calculate the free cash flow. You want a business with not a lot of costs and not a lot of needed investments like maintenance, capex. Because if you invest in a business like this with capital light, you will have a lot of margins, very high margins, very high profits, and the profits can be reinvested or distributed to shareholders like buybacks and dividends. So that's very good news. I have in mind some examples of asset-light business models. I'm often talking to them about them in this YouTube channel. Lands in Texas. You have TPL. Check this out. Texas Pacific Land. I've made a video about it. This is a business model with 90% margins. So yeah, asset light, not a lot of costs. And you want something with smart capital allocation. So spend excess cash on buybacks or dividends or token acquisitions. If you don't know anything about capital allocation, I've made a complete guide. You can check capital allocation guide on my YouTube channel, and I have complete guide on how you can think about capital allocation. A good framework, whether you have to do acquisitions or buybacks or dividends, in which situation. I have made a guide for this one. Okay, now the stuff that you don't want. The unattractive attributes. First, you don't want risky reinvestment. So high amount of capex or research and development costs with unpredictable return on investment. You don't want to invest in a company that will burn a lot of cash for something in the future that will not be profitable. Maybe now you may think about Mark Zuckerberg and the metaverse and the fact that Facebook is spending a lot of cash, is burning billions of cash to build virtual headsets that are not profitable. Yeah, that's an exception. And I can talk about other exceptions. There are big companies that burn a lot of cash for future projects. And luckily, Meta Platforms is very profitable in the social media part of the business, so it's okay. But there are some businesses that will use half of their earnings, reinvest into something unprofitable. That destroys value, that destroys the business, and that's exactly how competition comes into your table and eat your lunch. So you don't want to have risky reinvestments. Now, moonshot bets on vanity projects with a high chance of failure. Yeah, VR headsets or something else. It depends on the business model, but you don't want the business to be unpredictable. Investing in something that is very likely to be unprofitable. You want profitability. You want cash. You want reinvestments. Okay, you don't want to invest in a business with undisciplined use of cash flow. I may do a guide on this one for my YouTube channel. Issues too much compensation to employees and executives. So if a company gives too many stock options for free to employees, it dilutes all the shareholders, including you. So that's bad for long-term compounding. Fancy, expensive offices and extravagant work parties. Yes, if you invest in a company and the CEO is Jordan Belfort from The Wolf of Wall Street, maybe this is not the most conservative guy you could have as a CEO. Investing into executive pet projects, same thing. Unwilling to return excess cash to shareholders, same thing. Yeah, you want to invest. I mean, if you want to compound your money for the long term, if you want to buy great compounding machines, you want to buy great companies that care about their shareholders. Maybe this is purely obvious, but there are a lot of companies that don't care about shareholders. They want a yacht, they want a boat, they want a house, they want stock options, they want to get richer, and they don't really care about you. They mostly tech companies. They issue so many shares, stock-based compensation, so many costs. They will talk about disruption, M&A, AI, and they will dilute you. So that's a mess. And on the other part of the spectrum, you have boring companies. Their priority is the shareholder. Their priority is to grow earnings per share, free cash flow per share in the future. And that's exactly how you make money. So yeah, at the end of the day, the stock price follows earnings per share, free cash flow per share. So you want to invest in companies that grow their EPS, free cash flow per share. You don't want to invest in companies that dilute you, that don't care about you. If they are unwilling to return excess cash, that's very bad. So you want to avoid this kind of investments, okay? You want to also avoid unpredictable cash flows, economically sensitive cash flows, boom and bust industries, so cyclicality, discretionary products. Yeah, when there is a recession, these companies are dead. Large durable goods that lifespan can be extended during difficult times. Yeah, there are some businesses that sell products or services that are not that essential. So when families struggle, they just cut this expense and they don't buy these products. On the other part of the spectrum, you have companies that, even if there is a recession, even if we have lockdowns, even if there is inflation, families will continue to buy these products. You want to buy these kind of stocks, these indispensable stocks, these stocks that you cannot live without. And also you want to avoid shares with dual class share structure. Owner has disproportionately high voting rights to share ownership. Owner is not beholden to majority shareholders. What he's saying, Joseph Carlson, again, as a reminder, this is not mine, this is not my structure, I just like it and I comment it. What Joseph is telling us here is that if you have a stock with 2 shares, the first example I have in mind is Google. You have the class A, class C. They have different voting rights. I think for Google, so Alphabet, you have class A with voting rights and class C without voting rights. And I think the founders or the management may have class B shares. I don't know. I only own class C. I don't care about voting rights. As a shareholder, I just trust management, and my position is some few thousands of dollars, so I may not move the needle for this 2 trillion company. He wants to avoid dual class share because you have too much power as a CEO, as an insider, and this may not be good for shareholders. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Okay, let me continue. Now you have the attributes. That's the pure definition of what you want to avoid and not. I hope that's clear for the moment. I tried to give you some examples so that you really understand what he means with this analysis, but the slides are great. Now, as a reminder, you want to invest in great compounders for the long term. He shares some slides for the revenue of Costco. You see here since 85, so almost 40 years of gradual improvement, beautiful compounding snowball effect up and to the right. Costco is a beautiful compounding machine. And on the contrary, you have AT&T. That's not up and to the right smoothly. That's up and to the right, but that's a mess. I suppose they have acquisitions, and now it decreases, so that's not smooth at all. And you have a small commentary here. Costco is a compounding machine that has shown consistent revenue growth, primarily through price increases, increase in new customers, and opening new locations. AT&T is not a compounding machine. It has grown, its growth has been inconsistent, and in large part due to major acquisition outside of core business. That's not what you want. As a reminder, you don't want risky reinvestments. You don't want moonshot bets. You don't want to invest in something not related to your core area of business. So now you start to understand, the compounding up and to the right steadily, and not compounders. So extremely volatile revenue with some acquisitions. Again, you have an example, not for revenue, but for free cash flow per share. Again, this is my favorite metric in the stock market. You want a company to grow its free cash flow per share. Let's look at MasterCard, up and to the right, steadily, year after year. So nice improvement. And you have some company that is not a compounder, APA Corporation. I don't know this one. And you see the free cash flow per share, that is a complete mess. You have some negative cash flow, up, and then during 2013-14, complete mess. And now for the past 2 years, they generate some free cash flow. Let me ask you this simple question. What will be the free cash flow per share for APA Corporation in the next 3 years, 5 years? What will be its free cash flow? You don't have any idea. And that's the same thing for me. I don't know at all. And now let me ask you this question. Where will be the free cash flow for MasterCard in the next 3 years, 5 years? My guess is it will be higher. And I will be 99% sure and be right. So you don't need to add complexity to your investment game. You don't need extra points. That's Warren Buffett that said that you don't have extra points for the complexity. It's not a diving contest. You see on the Olympic Games, they do triple jumps. That's they turn around, and you have points for complexity. For investing, you just invest in simple business models that have shown that they can grow their free cash flow per share, because in the next 3 years, 5 years, 10 years, 20 years, they will grow their free cash flow per share. Compounding machines grow free cash flow per share over time on a steady and predictable basis. Other companies, like the oil producer APA Corporation, have unpredictable and low growth rates of free cash flow per share. Okay, now next step of the slides, next step of the analysis. You want to compare the shares outstanding, so the total number of shares. Remember what I said previously about share buybacks, managements that care about shareholders. They reduce the number of shares to increase the earnings per share, the free cash flow per share, and it will go up. Moody's is doing exactly this. This is the shares outstanding, and this is decreasing. That means they repurchase their own shares. They reduce the number of shares years after years, continuously. And you have JetBlue that is doing absolutely the reverse of this one. Either the number of share is stable or growing. So again, this will have an impact on total number of shares. This will have an impact on earnings per share, and earnings per share will have an impact on your stock price. You have a small commentary here. Compounding machines buy back shares with excess cash, with increases free cash flow per share, which increases free cash flow per share and reduces the total number of shares outstanding. Other companies dilute shareholders by issuing more shares to buy new businesses and pay stock-based compensation. So a form of salary. That's stock options. Now, that's done for the analysis. You have some key metrics. You want some superior business with share buybacks and predictable free cash flow growth. Now let's talk about temperament, because the stock market can be crazy sometimes. I mean, you are investor. I talk to you, my subscribers, and you are almost everybody is investing in the stock market. So you know how it feels in these crazy times when the market goes up, goes down a lot. That's a mess. Temperament is very important. Temperament is the personality traits that determine how someone will react given certain circumstances. Some traits are conducive to successful investing, while other traits are detrimental. Controlling temperament is key to long-term investing success. Okay, what is a good temperament? Someone who is not getting excited when the market goes up. Someone who is not sad or anxious when the market goes down. Someone who is patient and okay with being bored. As a reminder, you have a quote from Charlie Munger saying, "The big money is not done in the buying or the selling. The big money is made in the waiting." You have to buy and hold. Patience is a gift. You need patience to have great investment performance in the stock market in the long term. Okay, let's continue. A good temperament is someone who has not have the need to fit in with the pack. Maybe you need a contrarian investment to beat the market. No emotional attachment to stocks. Something about this one. Some of you, I've seen some comments, some of you fall in love with stocks. And I'm a victim of it too, because I begin to fall in love with Texas Pacific Land, TPL, but we have to, we have to remember that stocks don't know that we own them. Maybe that's important for us, but for them, we don't mean anything. A stock doesn't care if you own 10% of your portfolio into them. They don't care. They will continue to go up and down. Fundamentals matter. Fundamentals are what drive the stock market in the long term. So don't get emotional about stocks. Don't be attached. Don't be sad if it drops. These are all businesses that will survive. So they don't need you. They don't care about you. Stocks follow earnings, and you will lose a lot of hair thinking about your stocks as friends. So no emotional attachment to stocks. And you want the approach to be systematic and calculated during distress. Yes. When stocks go down, like, I don't know, the COVID 2020 or in 2022, I mean, markets went down 30% and 20%. You want to have a framework, a clear framework of, okay, I have done the work before, I have analyzed 50 businesses, I have target prices for all my favorite businesses. If the market drops 30%, I will buy this at this price, this at this price, this at this price. I will sell this, this, this. If you don't have a framework, you will do mistakes. This is not guaranteed, but 99% of the time, you will do mistakes. This is exactly what I tell my students in my coaching program. Have a clear framework. Do the work before the crash. So when the stock market crash happens, you are ready. You know exactly what to buy. You know exactly what to sell. You know exactly what to do so that you don't panic. You have a clear framework. So that's how you can take advantage of the volatility and make a lot of money. Now let's talk about the bad temperament. And somebody who enjoys gambling, who is excited when the market goes up, anxious and bearish when the market goes down, turns on TV, Twitter, and all the guy sees is red, red, red. That's the end of the world. We will have World War III. That's the end of the world. Most of the time, the end of the world doesn't happen. So I don't know why people do that. I don't know. That's the same thing that when you are sad, you listen to sad musics. That doesn't help you. That I mean, for me, that doesn't help. So if the stocks are going down and you continue to watch TV, Twitter, you stay in this circle of negativity, and that doesn't help at all. I mean, you want to be neutral when you think about stocks and investing. You don't want to be hyped. You don't want to be high energy, hyped up about stocks going up, but also you don't want to be depressed when stocks go down. The most important trait that Warren Buffett tells to be a great investor is temperament. Because maybe you are telling this to yourself, yes, but for me that's different. I'm strong mentally, so I think I can know how to deal with it. But how did you react in COVID? How did you react for the crash in March 2020? I mean, I've seen many people telling me that they were strong, but when the crash happens, they sold at the very wrong time. They said that it was going to get worse. We will have a small rebound, a dead cat bounce, and then back down again. It never happened. And you know what? They bought back the stocks that they just sold, but at a higher price. They didn't make money out of the crash. So that's an opportunity cost for them. Too bad. Let's continue. Buys out of fear of missing out and greed. Yeah, that's bad temperament. You don't want FOMO. That's very, very hard. You don't want FOMO and greed. Sells out of fear and future losses during decline. Exactly the example of the COVID situation I just talked about. Sometimes you think that the stock market goes down 10%, and you said it will be bad. It will go deeper, and I think it will drop 30%. But you know what? The stock market doesn't care if you wait or not. It will go down 10%, 15%, and then rebound strongly. And you are just waiting like this, and you don't know what to do. You don't know what to sell, what to buy, and that's it. And the stock market continues. The companies continue to live. And the last thing of the bad temperament is takes comfort in following the crowd. Yes, I see this with passive investing. You invest in the Magnificent Seven, and you are with the crowd, and you make money, so that's quite comfortable. But most of the time, the big companies underperform. Most of the time. Maybe this time is different, but most of the time, if you follow the crowd, you will have an average return. I mean, if all your investments are like everybody else, you can expect your return to be like everybody else. That's very simple. And you don't want your returns to be like everybody else. I mean, if you want your returns to be like everybody else, buy the S&P 500. You want an average performance, you will get an average performance. S&P 500, you will have a 10% return, 8% return in the long term. And that's fine. That's fine. But we are a channel of stock pickers, so we are greedy enough, risk takers enough to challenge ourselves, and we want more than 10%. We want 15%, 20%, 25%. That's our goal, and even mentally, that's a beautiful game. I learn a lot doing this. So that's research work, and you can make more money if you do good stock picking. And good stock picking means don't be comfortable with the crowd. Go against the crowd. That's how you make the most money. Okay, let's continue. Now let's talk about the intrinsic value. That's the third core pillar of Joseph Carlson's investment style. Again, that's his slides, so I don't want to take credit for this at all. He created the slides and everything. Check out his videos. Okay, for the intrinsic value, estimation of the intrinsic value. Intrinsic value is determined by ranking companies by free cash flow growth and predictability, then discounting them by determining the appropriate free cash flow yield. Free cash flow yield is similar to the price to free cash flow that I talk a lot in my videos. So the free cash flow yield they deserve to trade at. Intrinsic value is an estimate that is ultimately subjective. The more accurate and well-researched the assumptions, the more accurate the intrinsic value estimate will be. So there are three drivers of intrinsic value: the organic revenue growth, that's why you want a business to grow organically, you want free cash flow per share growth, and you want predictability. Okay, now let's talk about management. Oh, that's the last slides. Maybe just before the last slides, what he means here is to invest in companies that generate a lot of free cash flow that is growing with the free cash flow per share. So you have some per share metric associated to valuation. And if you think in terms of per share metrics, you think buybacks. You think of Moody's that can decrease the number of shares. So maybe you want to only invest in buyback machines. Again, I've done a video about this. You can check this out on my YouTube channel. You want to only invest in companies with organic growth and a lot of predictability. Look at MasterCard. Yeah, here MasterCard free cash flow per share is very, very predictable. And you can have a DCF and you can play with multiples, but you want to stay in this area for compounders: predictability, free cash flow per share growth, organic revenue growth. That's very good points. And out of all the investment universe, investable stocks, not a lot of stocks have these three criteria. Okay, let me move on. Last slide so you can do something else with your life. It's about portfolio management. Successful outperformance of the benchmark is most likely to occur with a portfolio concentrated into the highest quality companies. Concentrated portfolio. Buying losers can usually be avoided by following a disciplined buying and selling strategy. I'm struggling with this, so I am biased, and my goal is to invest in quality companies, but sometimes I'm tempted to buy inferior businesses because they are very cheap and there are some free cash flow generative aspect to them. So I will be biased for this slide and I'm struggling to it. So let's learn from Joseph Carlson. For the buying, buy only compounding machines. Buy when they are trading below intrinsic value. So normally at the end of your investing process, you have done the work. You know if they are predictable or not. You know if they are profitable or not. You know if they are cheap or not. You want to buy when they are cheap. Do not sacrifice quality for valuation. Do not add to companies becoming less predictable. There are companies that become less and less predictable as they evolve because they tap into new markets, because they do acquisitions, and you understand less and less what they do. That's less predictability. You want to avoid this kind of situation, and you don't want to sacrifice quality for valuation. In other words, don't buy bad companies when they are cheap. It's not because they are cheap that you have a good investment. So don't be tempted. That's what I'm struggling at, actually. Don't be tempted to buy a stock. Maybe it's a lower quality, but the price is so cheap, it may be a great investment. From what I've seen, it's as if you flip a coin. Sometimes you make a lot of money, sometimes you lose. So I will move away from this strategy of paying cheap for cheap quality. But yeah, only invest with the best, because most of the time, I'm telling you, most of the time, great businesses stay great. Great businesses generate strong free cash flow growth that is very likely to improve over time. More free cash flow growth. So, and that's how I can add to this process, portfolio management, to only buy companies with a long track record. So you can check if in the past 10 years, the company has grown the free cash flow per share. If in the past decades, they have consistently grown up and to the right, this is very likely that they will continue to grow up and to the right. Now for the selling. Sell when a mistake was done on original analysis. I will maybe do a video about this one. You can sell for many reasons. If you've done a mistake, you realize 3 months after the buy that, oh, I don't really understand this and this, let me get out of this. That's a perfectly good reason to sell. The second reason to sell is sell when the company no longer meets quality standards. If margins continue to go down, if they do bad capital allocation decisions, that's a perfectly good reason to sell. And sell when there is a far more attractive opportunity. The stock market is about the stock market is about risk reward, is about cost of opportunity. If you have a stock that you like a lot, I mean, superior business, but the stock goes up and up and up and up, and now they have a price to free cash flow, price to earnings of 100. And you can say that's really expensive, and I completely agree with you. Even a quality company selling at 100 times earnings, that is a lot. And in the meantime, you do your analysis and you find a great same quality of a business, but they are trading at a PE ratio of 25. Now you compare your two opportunities, either the expensive one or the PE of 25, so fairly valued. That's a more attractive opportunity. You can sell this one, the expensive stock, to buy this fairly valued stock. That's it for the complete investment philosophy of Joseph Carlson, how to find compounders to grow your wealth for the long term. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.